It is estimated around 25% of homeowners in the UK overpaid their mortgage in recent years. But with average mortgage rates around 5% and average global stock market returns around 9%, it may seem like the obvious decision is simply just to invest more rather than pay more into your mortgage. In this video, we're going to discuss this very nuanced debate and most importantly, walk you through the risks to help you decide whether you should be investing or overpaying your mortgage. When thinking about considerations, we have to start with the psychological element. Now, financially on paper, over the long run, the stock market will usually beat mortgage rates. But what that doesn't take into account is the journey you have to go on to get there. And it's that financial peace of mind. It's that feeling of coming into retirement, owning your own house, having no payments on it, reducing the amount of burden you're going to put on your pension and other income sources at retirement. A few years ago, I had up to £50,000 worth of debt, not in a mortgage, just in personal loans. It was on a fairly low interest rate, around 3%. So it may have seemed like the obvious decision would be to invest more, or even put money into cash savings because you get a better savings rate. But I just couldn't deal with that amount of debt, the burden and the weight that it brought. Even though in the long run, it would have made more sense to put more money into the stock market. I just had to get that debt down. It's important to remember as well that paying off debt is a guaranteed return on your money. So if you have a mortgage that, say, has got an average rate of around 5%, if you pay more into that, that's like getting 5% on your money. With the stock market, although on average it's going to return around 9%, and you can look back over the last 40, 50 years, and that's what the average has been, it's very rarely that 9%. You'll see wild swings, really good years where it's 20, 30%, but then also you have down years. When there's recessions, it could be down 20%. And that's the journey you have to go on. Yes, in the long run, if you just looked at one point in time and then looked 20 years into the future, it will seem obvious that you're like, well, I would have just got the better investment return. But you have to sit through those bad years where your account could be up to 20% down and make sure that you're okay with that. Also depends on where you are in your investment journey. If you're in your 20s and you've got a long time horizon, you've got plenty of time to let your money compound in the stock market. A mortgage is likely going to be some of the cheapest debt you'll ever have. You may also not want to stay in the same place. So if you bought your first house, you may stay in it for a few years. Then as your income increases, you may want to move into a bigger place. But if that psychological element in terms of that financial peace of mind, in terms of not having a mortgage, well, if you're just walking up the ladder, i.e. you'll always have a mortgage, but you're just going into a bigger house, well, then that's not the financial peace of mind that we talked about earlier. And actually, if that is your goal, then you may be better putting that money into the stock market because you're going to get a better return that if you then wanted to move into a bigger house, you could use some of that money to put towards that. On the other side of that, if you're in your 50s or 60s and you're coming up to retirement, having that financial burden off your shoulders in terms of paying off your mortgage is going to be huge. You also get that guaranteed return of paying off your mortgage. And you may take the view, especially if you're coming up to retirement in the next few years, that you have a shorter time horizon in terms of the time that you want to make your money work for you in the stock market. There is a slight counter to that, and that's paying into a pension. Especially when you're coming close to retirement, paying more into a pension can be a guaranteed return and a massive return at that because of the tax relief you get. And when you think about the levels of income you get over your working career, it's likely towards the end of that, you're going to be on the higher amounts, and that means you can potentially pay more into your pension. And you're also not going to have to wait a long period of time before you can then access that money. So it's not like you're parking away money for 20, 30 years, not being able to access it. So in that scenario, it may be worth looking to see whether you can increase the amount that you can invest into your pension, whether that's for a workplace pension. If your employer matches it, then even better. Or even into a SIP where you invest into that pension yourself, but you still get the tax relief on your contributions. Another important consideration to think about is flexibility. When you overpay your mortgage, once you've paid that money, that's gone. You can only access that money if you were to then refinance, where if you invested that into the stock market, say you put that into a tax efficient account like an ISA, you can access that money at any time. And I think this is important to look at your personal situation, because if you don't have, say, an emergency fund set up where you can cover unexpected expenses such as car breaking down, medical expenses, say that you lose your job and you lose that income, I think it's important to have that emergency fund set up first. If you have that financial safety net, then it's easier to pay more into a mortgage because you know you can cover yourself. Say you lose your income for a few months or any unexpected bills come up. But if you don't have that, then it's probably worth building that up first and probably building up some investments as well before then looking to pay off your mortgage. It also depends on what your loan to value ratio is. For most mortgages, if you have a loan to value ratio of less than 60%, you'll likely get a preferential rate. So if you're coming up to the time where you need to remortgage and you're potentially close to that loan to value, it may be worth exploring whether you can put more money into your mortgage to get it down to underneath that percentage that you need to get a little bit more of a preferential rate. So it means you're paying less interest over the long run. Once you've got your loan to value down to a percentage where you're going to get a preferential rate, then you can start looking to invest more into the stock market. You could also take the approach that the stock market is potentially a little bit overvalued, and what we're seeing right now is a little bit of a correction in it. And you could take the view that you want to wait for some form of substantial, not necessarily a crash, but even just a larger reduction. So say the stock market comes down 10, 15, 20%. That's the best time to invest into the stock market. So in the short term, you could focus on paying more into your mortgage, like we talked about, that guaranteed return. And if the stock market does come down a substantial amount, then that's when you could then pivot and invest more into those stocks, because then you're investing essentially at a little bit of a discount, and you're not potentially just investing into the stock market when arguably it could be seen as a little bit overvalued. With that strategy though, you are slightly at the mercy of global stock markets. There's no guarantee of when that crash or correction might occur. And you've got to think about what is going to be the feeling, the rhetoric at the time. If stock markets come down 20%, there's going to be a lot of fear in the market. A lot of people are going to be panic selling. It might not feel like the best time to invest. Even though on paper, if you take all the emotion out, it's absolutely the best time. But when you're in that moment, it's never going to feel like a good time because there's a fear that it might continue coming down. If you are investing into the stock market, it absolutely makes sense that you're utilizing tax efficient accounts such as an ISA. Make sure you've got reasonable pension contributions like we talked about because of the tax relief you get on them. It makes absolute sense that you're utilizing both of those vehicles. But say you've maxed out your ISA, you've put the £20,000 that you can put in each tax year, you've got a reasonable amount of pension contributions going in that's being matched by your employer. Well, then anything above that, if you're having to put money into a general investment account, which is not going to be sheltered from tax, then that's where them overpaying your mortgage makes much more sense. So as you can see, even though on paper, financially, it makes so much more sense to invest into the stock market because you will get a better return than simply paying more into your mortgage. There's so many factors and elements that you need to think about. It's so unique to you as well. What might be good for you might not be right for someone else as well. Like most things in investing, there's not always a clear right answer. It's what works best for you and your unique circumstances. I hope you found that useful. Let me know your thoughts in the comments and I will catch you in the next one.